Inventory management. Inventory represents a significant cost for many companies and needs to be managed. Inventory levels that are too low will result in a loss of sales due to stockouts. On the other hand, high inventory level means excess capital is tied up in inventory, and this also has a cost. When you have too much inventory, there is a carrying cost because money is tied up in inventory and is not receiving any returns. There will be storage costs. If you have excess inventory, some of that inventory might become obsolete. There might be pilferage and so on. The material that you see over here is actually a full course at most colleges, and what we have done is just summarize the most important points on one slide. The bottom line is that managing inventory involves a trade-off between too much inventory and too little inventory. When you have too little inventory, you run the risk that a customer comes and you don't have the inventory. When you have too much inventory, that results in high costs. So what is the optimal amount of inventory to maintain? There are two broad approaches. One is called the economic order quantity / reorder point, EOQ. The other is just-in-time inventory. This is the traditional method. Let's simplistically understand how this works. Economic order quantity refers to the optimal or economic amount of inventory to order at any given point in time. Reorder point refers to the point where you order inventory. Let's look at a simple picture. You have time on the x-axis and inventory on the y-axis. There is a certain amount of inventory that is called your safety stock or the reorder point. A company, given its business and given the rate at which it sells inventory, will have a certain safety stock, buffer stock, or reorder point that it wants to maintain. If this reorder point is too low, then the risk of stockouts is high. In order to manage the risk of stockout, in other words, companies want to minimize the probability of a stockout, they will pick an appropriate reorder point. Companies also need to decide how much inventory to order at a given point in time. That is the economic order quantity, and again, that will be based on carrying costs as well as the cost of a stockout. So this amount over here is the economic order quantity. When that order is made, then this is the inventory level. As a company makes sales, inventory will come down. When we hit the reorder point, then another order is placed and we come back up here and so on. In a given period, if the sales suddenly tend to be much higher, then we'll come below the reorder point. But that's why we have this buffer stock, so that we minimize the chance of a stockout. The other approach is called just-in-time inventory, where companies try to have the right amount of inventory at the right time in order to minimize the inventory balances that they carry. Evaluating inventory management. This is material you've seen before. You use these ratios: inventory turnover ratio and days of inventory. A high inventory turnover ratio means that a company is managing its inventory well, it is selling product quickly, and or it is maintaining a low balance. A high inventory turnover ratio would result in low days of inventory. Low days of inventory means that on average a company is maintaining low inventory. Obviously, when you evaluate inventory management, you need to consider how inventory turnover ratio and the days of inventory ratio are changing over time for that company, and you also need to compare relative to the industry. Take a look at example 5, which uses these ratios. Managing accounts payables. Accounts payables represents an important source of funds and should be managed well. Paying too early is costly unless the company can take advantage of discounts. Late payments impact a company's perceived credit worthiness. And as we've seen before, if a company is perceived to have poor credit worthiness, then the suppliers will tighten credit terms. It might be harder to raise money from banks and so on. Therefore, there needs to be a balance between paying too early and paying too late. As an analyst, you evaluate accounts payable management using the payables turnover ratio and number of days of payables. Here again, you need to look at these ratios over time and you need to compare them with other companies in the industry. You also need to be able to evaluate the cost of taking a discount and the cost of not taking a discount. If a supplier is offering terms such as 210 net 30, and as we've discussed before, that means that if you pay within 10 days, you get a 2% discount. Otherwise, you need to pay the entire amount within 30 days. So a question here would be, should you pay your supplier within 10 days and get the 2% discount, or should you pay at the end of 30 days? Let's say you pay at the end of 30 days. What effectively is the cost of not taking the discount? You need to find the effective return here, or the effective rate. How do we do this? This is day 0. You could pay on day 10 and get a 2% discount. If you don't do that and pay on day 30, what is the effective annualized rate? You can think of the problem as follows. Let's say that the product is sold to you for 100, but if you think about it, if you pay within 10 days, then you are only paying 98. So really, the product is for 98, but if you don't pay within 10 days, then you pay 100, or you pay $2 interest. If you paid over here, you would pay 98, but if you are paying over here, then you are paying 100. What is the rate that you are paying for this period, which is 20 days? The rate for 20 days that you are paying is 2/98, which is just a little bit more than 2%. How do we annualize this? What you need to do is take this rate. If this is for 20 days, then the most precise way of annualizing this is the following. You do 1 plus the 20-day rate and then raise to the power of 365 over 20. This is the 20-day rate, and you are annualizing by raising this to the power of 365 over 20, and then to come up with the rate, you subtract 1. When you do the calculation, you should get 1.446, that is this number, minus 1, which is 0.446, or approximately 44.6%. In other words, the cost of not paying within 10 days or not paying on day 10 and not availing the trade discount is 44.6%. This is a very high cost, and clearly what you should be doing is paying on day 10 rather than paying on day 30. If you pay before day 30 but after day 10, then the rate will be even higher. This might seem a little complicated, but all you are doing is computing the effective annual rate. Hopefully this makes sense. Approximately the interest that you are paying here is 2%. This 2% is for a 20-day period. And then when you annualize to a 365-day period using this method, you get about 44.6. Let's say that the number that you calculated was lower. It was, say, 16%. How do you know whether or not to take this discount? What you need to do is compare the 16% with the return that you are getting on your funds. If this 16% is higher than the return that you are getting on your company funds, then you should avail the discount offered by suppliers. On the other hand, if you are getting a higher rate on your funds compared to the rate that you are getting from your suppliers, or the discount from suppliers, then you should make your payment on the last day. Managing short-term financing. This is the last section in this particular reading. Short-term financing strategy should focus on ensuring that a company maintains a sound liquidity position. This involves ensuring sufficient capacity to handle peak cash needs. Companies should maintain sufficient sources of credit. In other words, companies should not be totally reliant on just one bank. Large companies should ideally have a relationship with multiple banks. Companies should also ensure that the rates that they are getting on short-term financing are cost-effective. Short-term borrowing could be from banks or from non-bank sources. Bank sources include uncommitted lines of credit, committed lines of credit, and revolving credit limits. Uncommitted lines of credit are the weakest form of borrowing because even though the fee involved here might be zero or minimal, but the bank from which you are borrowing is not making a commitment that it will give you the money when you need it. With committed lines of credit, a company might be paying a certain commitment fee to a bank, but then, as this name implies, there is a commitment that the company will be able to raise money when needed. This is a popular mechanism in most countries. Companies that do not have sufficient credit quality, in other words, it is difficult for them to borrow from banks, they could borrow from other financial institutions using asset-based loans. In other words, companies put up specific assets as collateral and get money in return. Finally, companies can issue commercial paper or bankers' acceptance. These are other methods for raising short-term funds. Commercial paper is a corporate equivalent of a T-bill where a company issues a short-term instrument called a commercial paper. These are generally issued based on a discount basis. A company might say that after 30 days it will pay 100 and today it receives 99. Almost exactly like a T-bill. Bankers' acceptance, these are instruments that are used in the import-export business. I don't think you need to get into the details at this stage. Just recognize that this is a mechanism for raising short-term financing. From an exam perspective, you need to know how to compute the cost of borrowing. The point here is that a company will have different sources or different ways to borrow. A company would need to figure out what is the most cost-effective method. Based on the examples in the curriculum and the questions at the back, I would say that you should know how to do this question. After doing this question, you should do example 7 in the curriculum, and then there is also a practice problem that is almost exactly the same. You need to borrow 1 million for 1 month, and there are 3 options which are shown below. Which one has the lowest cost? And hopefully this is obvious. When you are borrowing and you have different options, all else equal, you want to borrow using the lowest cost option. The first option is drawing down on a line of credit at 5.5% with a 0.5% commitment fee on the full amount. And since we are borrowing for 1 month, we will allocate 1/12 of the commitment fee to the month. What is the overall cost of borrowing? Here is what you need to do. Recognize that this is for 1 month and the rate is 5.5%. So you do 0.055 into the 1 million. And then since the borrowing is for 1 month, you multiply by 1/12. Plus you also need to pay the commitment fee of 0.5%. That is 0.005 into 1 million, and we are only taking 1 month's worth. This entire amount is divided by how much is being borrowed, which is 1 million. And since this number is for 1 month and you want to annualize, we multiply by 12. If you do the maths, what you should get is 0.06 which is equal to 6%. So the cost of the first option is 6%. Now let's look at the banker's acceptance. The second option is using a banker's acceptance where we have a 5.75% all-inclusive rate. You need to remember that a banker's acceptance is a discount instrument, which means that the interest is paid upfront. Here is how we calculate the effective rate. It's the interest divided by net proceeds into 12 times 12 because we are annualizing. Interest is 0.0575, that's this rate, multiplied by the amount 1 million times 1 over 12 because the interest is being paid for 1 month, divided by net proceeds. 1 million is how much you get, but then you need to pay the interest upfront. So this entire interest amount is subtracted to come up with the net proceeds. We multiply by 12 to annualize. When you do the maths, you should get 0.0578, which is 5.78%. It should not be surprising that 5.78% is greater than 5.75% because we are dividing by a number that is less than 1 million. Coming now to the third method, commercial paper. The rate is 5.75%, but we also have a dealer's commission, which is 0.125%, and a line cost, which is 0.25%, both of which should be assessed on the 1 million commercial paper. You need to recognize that a commercial paper is also a discount instrument. Just remember that a commercial paper is like a T-bill. So how do we calculate the effective cost? We take the interest cost, which is 5.15% times 1, that's the total amount, times 1 over 12 because we are calculating the interest for 1 month. Then we add the dealer's commission, 0.125%, that's right here, on 1 million for 1 month, and then the backup line cost, which is given over here, divided by the net proceeds, 1 million minus the interest amount, and multiply the whole thing by 12 to annualize. What you should get is 0.0555, which is 5.55%. Now that you have the rate for all three instruments, you can see that the commercial paper seems to be the lowest cost option. As I mentioned before, do example 7, which is exactly the same. The calculations might look tedious, but the concept is straightforward as long as you recognize that instruments 2 and 3, banker's acceptance and commercial paper, are discount instruments. You need to figure out how much you are paying divided by how much you are getting. That brings us to the end of this reading. As I mentioned, it's a long reading in the curriculum, but there are only 7 learning objectives, and I have focused on the testable elements and the learning objectives. You need to know how to manage and measure liquidity. This is critical because ratios is what you use to measure and evaluate liquidity. We've covered the ratios here, plus we've seen the ratios earlier. Just the point to remember is that in FRA, we talked about the current ratio and the quick ratio as liquidity ratios. The same applies over here. But in this reading, we are also referring to activity ratios as liquidity ratios. We then talked about managing the cash position. The basic idea here is that companies don't want a negative cash position because it would be expensive to raise short-term funds. Companies have a target cash position that they want to maintain. It is important for companies to forecast the cash inflows and outflows in order to manage cash properly. Money that's not needed on a day-to-day basis is invested in short-term instruments such as T-bills. Here the key point is to understand the different yield calculations, and a company needs to evaluate how it is doing by comparing its weighted average yield with a benchmark rate. Managing accounts receivables. Here the testable element is the use of ratios. We need to know how to calculate the receivables turnover ratio, the days of receivables, and recognize that our basic days of receivables measure does not take into account the age of receivables. We talked about a slightly more elaborate calculation which computes the average days outstanding and uses the aging schedule. Managing inventory, there is a trade-off between having too much inventory and too little inventory. If you have too much inventory, then the cost of inventory is very high. If you have too little inventory, then there is the risk of stockouts. Managing accounts payables, here again there is a balance between paying too quickly and paying too late. You need to know how to compute the payables turnover ratio and days of payables. Managing short-term financing, here you need to know the calculation that we did. Companies need to have mechanisms in place to borrow short-term, and that borrowing should be at a cost-effective rate. When there are different options for borrowing, such as borrowing based on a line of credit or commercial paper or banker's acceptance, then you need to be able to compute the rates, and obviously we should go with the lowest cost option. As always, read the summary. Extremely important to do the learning objectives because this lecture has focused mostly on the learning objectives. If you have time, you can do the whole reading, but as I mentioned, this is a very long reading in the curriculum. The examples are good, that's why I have asked you to do them. Practice problems, good but not enough. Most of them focus on ratios, which leads me to believe that ratios is the most testable aspect of this reading. Do practice questions from other sources as well.